Welcome back to QAV Australia. Tony, record high on the All Ords, Tony. Even though it's come off a bit, I think it's still a record high. Where are we today? What day is it? Tuesday, the 22nd of July, 2025. All Ords is 8,932 at the moment. Was up over 9,000 on the 18th of July. Because, the world's going great. Everything's going great in the world. There's no issues. No reason not to be completely optimistic about the state of affairs, Tony.
Well, not just that. I mean, there is a bit of a disconnect now in what we're paying for shares and how much they're earning and what their earnings growth are. So it'll be an interesting reporting season coming up in August when we see some numbers. I mean, the projections are that they're not going to be shoot the lights out results across the board. So, there'll be patches of it, I guess. But yeah, there's certainly some high valuations, especially in like Commonwealth Bank. But that's been raked over a lot in the financial press. A lot of passive investing going on with that. But that can hold up for a long time.
I was thinking about something in the car today I wanted to ask you about. We've probably talked about this before, but I don't recall. In your experience over your many decades, does QAV have its home run year typically after a crash?
Maybe I'm just trying to think back to some of the home runs years. A qualified, yes. Like it won't be. What I found after the GFC, just using that as an example, was it didn't happen in 2009 or 2010 from memory. It was more like 2013 from memory. I had a home run year, and that was against the backdrop of a lot of people steering clear of equities because of the GFC. They were burnt. They weren't coming back into the market. So there was that. But yeah, I certainly did well at the end of the GFC. I think it was the March reporting season in 2009 when everything was reporting relatively good numbers and they were trading on very low multiples. It was a good time to buy. So yeah, potentially.
As I was thinking about what you told me about the post-GFC and what I saw happen post-COVID, and thinking about the fact that when people are scared off because the market's just gone through a big crash because they don't have a system, they don't have rules that are telling them what to buy and when to buy in, which we do, then I was wondering, should we just sit out the market for 4 years and then every time there's a crash, that's when when there's blood on the streets, we just buy in then? Then your money's not doing anything for the intervening 4 years, I guess, right?
Yeah, and then you can still have good years in those 4 years too.
Yeah. But yeah, it just struck me that, I mean, that's why we would probably outperform in those post-crash years, because we try to stay fully invested and we have rules that tell us what to do in that scenario, whereas the vast majority of investors don't, and they're scared off. So, they're staying out of the market.
Mm-hmm. Yeah, I mean, there's certainly a contrarian element to staying in the market when everyone's leaving, for sure.
Well, yeah, but from our perspective, it's not really contrarian. We're just following the system that says, buy this. It's generating cash and it's cheap, But from the outside perspective, from the outside, it looks contrarian, I guess. Yeah. So that's, when people out there who are new to QAV or have been doing it for a few years and have had, we had a couple of average or tough or bad years, 22, 23, last year or two haven't been too bad. Not shoot the lights out, but okay. But what we're really looking for, what we're waiting for, is that cyclical wipeout. In a way, we kind of want the wipeout. We don't for society, but for us, the post wipeout is the big money year.
Potentially, yeah. Look, you're probably right. I'd have to go back and look at the years and analyse them, but as you said, the market's at a high and we outperform the market. So we still get good returns in good years for the market as well.
Yeah, well, speaking of which...
Well, sorry, just one more thing to say on that too is the QAV numbers that I've used before on the podcast would be greatly enhanced if I had have started in the depths of the GFC. So its
Yeah.
starting points really matter for long-term capital
Yeah.
CAGR results. And I only mention
Yeah.
that because if you look at someone's returns over a long time period, pay attention to when they started investing. And
Yeah.
if they started in a sort of run-of-the-mill year, then their returns are probably a lot more indicative than if they started in, post-COVID or in the middle of COVID or in the middle of the GFC or something like that. Where coming out of it, you get a big tailwind from the market re-rating upwards.
Well, speaking of portfolios, just my portfolio report for the week. Our dummy portfolio, if I look at it from our fully invested date, 2nd of September 2019 to today, it's up 15.11% per annum. Almost a even split between capital gain and income return, about 8% for capital gain and 8.7% for income return, which is interesting.
Mm.
And that's versus the benchmark, the SPDR 200, which is 8.47% per annum over that period. So we're doing not quite double, but a little bit less. So I don't know, 90% better, something like that.
Just on that, Cam, so half the portfolio gain is through dividends, but we don't really capture the franking credits in our analysis, do we? I don't think Navexa gives us a benefit for that from memory. I could be wrong.
The franking credits. Yeah. I don't know. I don't know how they track that. So if they're not, then our performance would look better than what it already looks, which is almost double.
Yeah.
Oh, sorry. Speaking of Navexa, we did have the CEO of Navexa, Navar Trusselot, on a few weeks ago, and he teased that they were coming out with their Navexa AI. It is out, has been out for a week or two. I've had a little bit of a play with it. I haven't found anything super special to do with it. If I open up the little window, it says, "What can you do? I can help you analyze your portfolio in various ways. How is my portfolio performing this year?" Well, I can just look at the graph and see that. I don't know why I need AI. What's my portfolio performance since inception? Again, I could just do that. I might be able to ask it, what's my portfolio performance since 2/9/2019? Well, now it's giving me a different result to what the graph gives me. It says 14.34% versus 15.11%, but I did finish my charters yesterday and it's finishing it today, so I don't know if that makes any difference. Maybe it's down a bit today, but it's pretty close. All right, so you can type in those sorts of things rather than play with the calendar. But apart from that, like, it's not really, I haven't found anything yet that's easier to do with their AI service than it is just to do it the old-fashioned way. But
ask it what it thinks of
maybe
Bitcoin.
I'm missing. Really? Okay.
Probably says something like number one investment return for Navexa users.
You're an idiot. I guess, sorry, I can't help with that. This request is not supported. Yeah, it doesn't want to give you any opinions.
Oh, yeah, right. Financial advice, of course.
If I look at the last, let's say, 30 days, how have we done? We're up 5.63% in the last 30 days versus the benchmark up 2.24%. If I look at this calendar year, can I do that? Current calendar year, yeah. This calendar year, we're up 9.8 versus the benchmark up 8.38. So what are we in, July? Nearly 7 months into the year. So not killing it for the calendar year to date. Anyway, that is the dummy. If I look at the light portfolios as a group, year to date, they're actually doing better than the dummy portfolios. The light portfolios are up 10.35 year to date. Last 30 days as a group, they're up 4% versus 2.2. So yeah, they're doing okay. Everything's tracking along well because the market is just sort of booming at the moment for reasons that are not clear. The optimism is high. Even the Reserve Bank holding their rates last week, whenever it was, a week or two ago, did nothing. Market kick up for a second and then went, nah, it's all good. Record high.
Well, they kicked up when the latest inflation data came out. Towards the end of last week, I think, from memory. That's one of the reasons why they reached an all-time high, because again, the market's pricing in a almost certainty of an interest rate cut when the RBA meets next month.
You know why I think the market's up is because Trump's not going to release the Epstein files. And all of the power players who are in Epstein's files are like super happy now that...
and now they're buying more stock?
Yeah. Right. They're doubling down. Yeah, it's all good.
Oh.
I'm going to talk about in After Hours. I'm reading a biography on Robert Maxwell at the moment. So I'm going to talk a little bit about that in After Hours. It's fascinating.
Yeah, anyway. I only know what was in the papers. Fell off a yacht. Father of Ghislaine.
Miss Ghislaine.
Ghislaine. Is that how you pronounce it? Okay.
Ghislaine. Yeah, Ghislaine. I
don't think I've ever heard anyone say it. I've only heard it.
No, me either. I used to pronounce it Ghislaine. Yeah, it's Ghislaine. ChatGPT, Tony. I know you love your AI. Never heard you say a bad thing about your AI. It's always loving it. Loves his AI, this man.
I use it. Wouldn't say I love it, but I use it.
Then you complain about it constantly.
Oh, when I try to code
They just launched yesterday or day before. They launched their first agent, and I don't have it yet. You got to they rolled it out to their top tier accounts first, the pro accounts, which is a couple of $100 a month. Taylor signed up for the pro account just so he could get his hands on it. It's being rolled out to plus users, which I am, the $20 a month account. It was supposed to be today, but they've had some technical issues. They said it'll be tomorrow now. This is where you can tell it to do stuff, and it'll just go away and do it. It can log into websites, download stuff, build spreadsheets, etc., etc. Taylor and Hunter were using it yesterday to do a bunch of complicated things, and they were blown away by it. They said it took a little while to program it to do what you wanted it to do, which is typical with these things. And I've learned that from using it to write code too, is you think you know what you want and you tell it, and then you realize, I have to tell it actually do it this way or do it that way, or you have to log in here or whatever. But they had it compiling lead lists for their businesses. So basically going out to a website that has, it's kind of a LinkedIn sort of thing that has people with certain job titles in certain regions and certain companies, and saying, compile me a list of people that are the CMOs at companies that look like this, that are interested in advertising on TikTok, and give me their phone number and their email address and their title and blah, 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 and throw that into a spreadsheet for me. And it just did it. It was just pulling it down. Not 100% accurately, Hunter said. But anyway, my point is, when I get access to it, I'm going to try to use it for qualified audits.
Yeah, good.
Be my latest attempt to use AI to be able to do an update. I did send Taylor he said, look, if you give it something you want to do with it, send it to me because I've got plenty of credits. I did send him a prompt for that yesterday, but I don't think he's had a crack at it yet. But so sometime this week, I'll have a crack at that and I'll be able to report back next week. That would be one of the last hurdles in automating QAV for me, particularly if I can get it to just do it, after every reporting season. Just do an overnight run, give me the audit status, throw them into a spreadsheet, and that's that.
But that's good timing because we're going to get annual reports fairly soon.
Yeah.
Maybe we could, maybe you could, if it works, monetize it and sell it to people as a product offering. Here are all the qualified audits on the ASX, because we've tried to get the ASX to keep a list for us? Because I think it's vitally important to know if the company you're thinking about investing in has, had a red flag about its going concern raised by the auditors. But it's very hard to find, as you found out.
Yeah, I'm not sure that anyone outside of us cares that much about it. If they did, it might be available as a database out there.
Yeah.
I remember when we had Tim Lincoln on, he didn't even know what a qualified audit was, and he runs Stock Doctor.
Well, I think, to be fair, he didn't know what our terminology was, but yeah,
That's
he
our
wasn't
terminology?
he wasn't looking at it.
No, but I mean, that's my point. Like, he
Mm.
runs Stock Doctor,
Correct.
and thought when we said a qualified audit, it meant an audit. Just they had an audit that had been signed by somebody who's qualified, and like an auditor. Stephen Mabb, Chairman Mabb, sent us a link, or pointed out that there was the story in the Financial Review today. Where did that go? Had that. Oh, there it is. Companies with robust cash flow tend to be winners. Here are 9. Despite pandemics, wars, and bear markets, some companies just keep generating cash. By Todd Hoare, head of public markets at LGT Crestone. He says, it's the mantra every business owner lives by, and one that every investor should note. Cash is king. Unlike earnings, which can be adjusted with accounting tactics, cash flow, particularly free cash flow, reveals what a business actually generates and retains after it pays its taxes, interest, debt, capital investments, and any other obligations. It's the true cash available to reinvest, acquire, or return to shareholders via dividends and buybacks. That's why strong, consistent, free cash flow is a hallmark of high-quality companies. Earnings can lie, cash flow doesn't. This distinction matters. Investors learned it the hard way with Enron, which reported 13% earnings growth annually from 1996 to 2000, but posted negative free cash flow every year during that period, burning through over $5 billion before collapsing under the weight of too much debt and fabricated accounts. So that sounds familiar.
Yeah, I just wanted to tease out one of the things about that article. It's focusing on free cash flow, and we focus on operating cash flow. I have a lot of sympathy for investors who use free cash flow as the basis of their investing. However, it comes at the bottom of all the financial statements. As that article said, it comes after earnings are being calculated, it comes after capital or CapEx has been calculated, interest is worked out, taxes paid, dividends are paid, etc., etc. So yeah, it's the retained earnings of the company, and the company should have positive retained earnings to be investable. So I get that. But I have shied away from free cash flow over the years for the same reason I've shied away from PE ratios and earnings to a ratio of operating cash flow to price, because operating cash flow is at the top, and you don't have to worry about whether the company has made the right decisions about all the items on the way down to getting to its earnings, provisioning, how much capital it needs, how much depreciation it charges, what goodwill it has, what's it worth, what's it carrying value, etc., etc., etc. So, if you focus on cash flow because you think earnings can be manipulated, then I focus on operating cash flow because it's the hardest to manipulate. Whereas free cash flow is the end result after all the manipulations, if you like. So I get it why it's focused on, because if you've got positive free cash flow, that's a good thing. But I prefer operating cash flow because it's the least able to be manipulated.
Is there any value in assessing both and scoring both independently?
Potentially, but it's also similar to, say, using the PE ratio, which is the earnings ratio as well, and free cash flow.
Sure.
And there is certainly something to be gained from that, because a stock might have a high prop CAF and a low prop CAF and a high PE ratio, and that might be an indicator that it's a capex heavy business, for example, because it's throwing off lots of cash, but it's not hitting the bottom line in the same way or in the same ratios. So that can be something worth investigating. But Yeah, I haven't done the work to put those two things together. I've just left it price to operating cash flow.
My issue with this article was it says here are 9 in the headline, companies with robust cash flow. Here are 9. Then he spends a good couple of paragraphs talking about Hermes, the Italian, are they Italian? I don't know, French maybe, fashion house. And that's it. No, and then I was like, where's the others? Yeah, and then he goes, oh, and Microsoft, Accenture, MasterCard, Costco, Novo Nordisk, Richmond, Ferrari, and Australia's REA Group. Just gets them all out there in the third last paragraph. Like, I was like, oh, I thought you were going to give us a breakdown on all of those businesses. No, just throw them out there.
And doesn't give us a threshold ratio either, because like REA Group trades on a very high PE, because people have worked out that it's throwing off lots of cash.
Yeah, I wonder why he spent so much of the article talking about Hermes.
You thought he might have owned Hermes.
Oh, I'm just speculating, Tony.
Yeah, speculation.
Yeah, speculating that he might have an interest in Hermes. Doesn't disclose. There's nowhere in the article that says that he does or doesn't.
I wonder if
which you would think.
I wonder what the Fin Review policy is on journalists owning stocks that they report on.
Well, this guy's not a journalist. He works at a
it's a fund. Okay,
wealth management firm or a fund or something like that.
Yeah,
but still, he's writing an opinion column in the Financial Review, plugging a stock. You would think there would be some sort of disclaimer, mandatory disclaimer in there. That seems kind of shoddy, don't you think?
Well, it's a really good point. Now I've come to think of it, you've raised it. You never see at the end of an article, this article's about BHP and the author holds shares in BHP.
Well, generally speaking, we can assume they don't, because we know that most financial journalists know bugger all about investing after what we learned from your mate Alan when he was on the show. No, I don't invest, Tony. No.
I must admit, I'm just trying to remember now. I played squash with a Financial Review journalist many years ago, like in the 80s when I first moved down to Melbourne. We were in a squash team together. And he did mention at one stage that he did have a lot of first mover advantage on information, because he would go out and interview a small cap CEO or whatever, and they tell him stuff that wasn't widely known, and he would, before he printed it, have a time to make an investment. He didn't say he did. He just said, this is what can happen.
It should be like the Conversations website. Like any article on the Conversation, there's a disclaimer on the side. This journalist or this scientist does not make any money out of this, or does not get funding, or does get funding, or conflicts of interest, or it's like par for the course in the Conversation. Should be that for the Financial Review or any financial paper, come to think of it.
Yeah, that's a good point, Cam. So do we have to assume that every time someone writes about a stock that they actually own shares in the stock and they're pumping it?
I would.
Or they've shorted it?
Yeah.
If it's a damning article, they've shorted it?
Yeah, absolutely. The only other story I've got is something that I got from Ed, posted on Facebook this morning. PRU put out an update on their Nyanzaga gold project. I don't overly understand mining jargon, so put their December 24 update against today's and ask ChatGPT to tell me what matters as a shareholder, he says. I took the latest release from... ChatTK. Ask the original AI, ChatTK. All right, ChatTK, give us what it means.
Oh, in a nutshell, it's at the end of the announcement where they talk about discovering some more ore bodies in their gold mine precinct in Africa, which is likely to extend the life of the gold mine past 12 years.
Right. Chat QAV, that's what we should call it.
Yeah, Chat QAV. We should change the name of the show and call it Chat QAV.
Chat QAV, yeah. Well, I asked my Chat GPT to give me a TLDR on it. It said, Perseus Mining has been punching a lot of new holes into its Nyanzaga gold project in Tanzania.
Did it really say that?
The latest drill... Yeah.
Huh.
The latest drill results are thick, rich in gold. And I wrote, sounds like you, TK, thick and rich in gold. But thick spelled like the kids do, THIQ, just means big booty. Like,
Really?
what's her face? Not Janine Garofalo. Who am I thinking of? Kanye West's
Beyonce.
ex-wife.
Oh,
Oh, well,
Kardashian.
maybe too. Yeah, like a Kardashian booty. They say it's a thick booty. And sits below the pit they've already designed. Says they've drilled the length of 350 footy fields, over 35 kilometres of extra holes to tighten spacing and chase gold deeper. Best intercepts include 54 metres at nearly 10 grams per tonne and 23 metres at 21 grams per tonne. Thick zones of very high grade gold. Think 2 Olympic swimming pools full of rock averaging 10 grams of gold per tonne. So, I haven't looked to see what PRU's share price has done today. Have you?
I haven't, no.
I'll look it up now.
Yeah, so the upshot is,
oh my God,
they're talking about what they've announced to the market as being their cash flow, or their free cash is going to go up because of this extra ore bodies they found.
Well, the share price absolutely spiked when this came out today.
Cool. I own PRU, by the way. I should. Unlike a financial review journalist, I'll announce that I own shares in Perseus.
We all own PRU, I think. It's one of the QAV mainstays, I think, these days.
Golden stock.
Yeah. Let me just see what it's done today in my charts. PRU, I hold it in a couple of light portfolios, my super portfolio. We've put it out there as a possible buy way back last year, 2024. And Excel has frozen up on me because it's trying to update. Oh, here we go. Oh my God. So slow. 2025 in Excel is just so slow. Oh, it's only up 1% today, according to this. No, it's got to be up more than that.
Well, the announcement came, when the announcement came out, it was a couple of days ago, wasn't it? I saw it over the weekend, I think. Must have been Friday.
I thought he said it came out only this morning.
I put it in my notes at the end of last week. I'm pretty sure I saw it then.
Oh, okay. All right. Anyway, good stuff for PRU holders. No, it's up 4% today. Just updated my spreadsheet. But yeah, I bought it. I added it to my super back in April last year. It's up 61% since then.
Another parenti.
Yes.
It's doing a parenti.
I added it to.
It's up 1 parenti.
It's like a mooch.
Yeah.
You heard Mooch talk about a mooch?
Yeah, I have. You can remind me
One
that.
Scaramucci. Scaramucci worked for Trump in his first term for 11 days. So he says, how long you last working for Trump is rated in units of a Scaramucci. How many Scaramuccis? So Elon lasted, was it like 6 months? So that was however many,
100 Scaramuccis.
20 odd Scaramuccis. That's how he like. What else have I got? That's it. That's all I got. What do you got on your talking points, TK?
Yes, I came across a couple of interesting things regarding active funds versus passive funds. And from just sort of, okay, so one source was one of the readings I did for the maintaining of our authorized rep license. So it's a module in the training section from Kaplan, who's the online service provider that I have to sign into and do 12 units a year to keep our license to be able to give general advice. But anyway, they had a section, one of the units you could do was about active versus passive funds and ETFs. And there was some interesting things there I wanted to just share with people. The first thing to note was that this article referenced the 2024 SPI VA Australia report, and that's the report that compares active funds versus the index. And according to the 2024 SPIVA report in Australia, 56% of active managers underperformed the benchmark in general funds, which is consistent with the long-term average of 58% underperformance. Global equity general funds were worse. They were 85% of active managers underperformed their benchmark. And similarly was also the case in the Australian REIT category. And but, however, active Australian managers in bond funds and mid and small cap categories achieved a majority of outperformance for the second consecutive year. So some pockets of good news for active managers, but generally a fail. And over the 10 years, the SPIVA is saying the probability of sustained outperformance is low. 82.7% of Australian equity general funds underperform the S&P ASX 200. So that's quite a lot. And I put that together with some internal research I saw. Climb, which is a company I'm a director of, and I'm not going to give away any market secrets here, but there was discussion around similar sort of trends, I guess, in the market when I was talking with people at Climb. And I asked them, why do you think active fund managers generally underperform the index? And two things emerged during the discussion. One was that a lot of active fund managers are set up to fail based on their mandate or what they say they're going to do. And that's especially the case if a fund manager says things like, I'm going to outperform the index, I'm going to provide an above market yield, and I'm going to do it with below market volatility. And mathematically, those three things work towards you underperforming the index. So you're either outperforming the index, but your volatility's not working, or you're getting above market yield and you're underperforming the index, or you're doing all three to the best of your ability, and the result is you're slightly below the index. And so there's research papers out there which show that. So I thought that was interesting. However, when I ask the people who are on the coalface talking to investors in these products, and bear in mind that the market for a lot of funds in Australia tends to be for when people have accumulated some assets. So you're talking about people who are at least a good part of their way through their career, and they've got some assets to invest. So you're not talking about young kids here. You're talking about people sort of 40, 50 years plus. They actually prize low volatility above outperformance. So the sort of feedback from people who deal with these types of investors and clients all the time say what they get praise for and what they get people being happy with is, we don't mind if you've slightly underperformed the index, but if the market goes down 6% and you've gone down 3%, we're happy. So there's kind of a bias towards low volatility there. So there are a couple of interesting things I thought, and perhaps go a long way to showing the way the markets have evolved in active land towards providing lower volatility, which means it's harder to outperform the index.
Right, but before you go on, can we drill down on that a bit?
Yeah, sure. I thought you wanted.
Yeah, so you said that the things that they say they're going to achieve are a combination of higher capital return, outperforming the index, higher yield, higher average yield, and lower volatility. But from the sound of it, you're saying that the market, the customers in the market, stack rank lower volatility over the first two. That's what they care most about.
Correct. And I think it's also implicit in what I heard was that the customer doesn't volunteer that stack ranking up front. they appreciate it when it happens. They don't go out and say, give me a fund that's lower volatility. They'll go into a fund that promises all three, but they'll prize lower volatility higher than the other one. They'll forgive underperformance on capital appreciation if the volatility is low.
Fascinating.
I thought so too.
Mindset wise.
Yeah,
and they say that they will appreciate that because they can tell that because people don't pull their money out. I mean, how do
correct.
they know what the customers think? They don't pull their money
because in a company like Klein, they're dealing with financial planners who provide the feedback. Because one of the questions I had internally was, why are financial planners pushing people towards these kinds of funds, which for a long period of time have not underperformed massively, but just slightly underperformed in terms of the capital appreciation metric? And the answer is because customers are more worried about not having big drawdowns when the market falls.
And why would that be, do you think?
Capital preservation, especially if you're going into retirement. You don't want to, go through a GFC and have a huge drawdown. Now, you and I know from Sammartino's interviews that you don't worry about the capital, you worry about the dividends in such a situation. But I don't know if every investor sort of mentally is tuned into that kind of wavelength when it comes to managing their retirement savings.
Isn't that the job of the financial planner to help them tune into that?
It is. No, it is. Yeah. Yep. But I wonder if there's this dance going on where the financial planners are pushing them towards funds which have a lower volatility, which therefore underperform, but everybody's happy. And maybe the financial planners have found it too hard to educate people to accept a little bit more volatility and focus on dividends when the market's down and just stay the course.
Yeah. Okay. Interesting.
I thought so. And then the other thing I found when I was reading this unit on Kaplan was there was a lot of drill down on what is a passive fund. It's a bit like oils ain't oils. And they drilled down into how index funds works and what makes them up. And it was fascinating, I thought, because again, the research was showing that index funds or ETFs tracking the same index could have up to a 3.2% variance in their returns. If you think about, as we said before, the market's, whatever it was this year, 8%, I think you said, 3% variation is quite a large number if you're trying to track that index. The average spread was 1%, so it's, not that volatile, but it can be up to 3%. And there's a few interesting reasons for it. So even though index funds are passive, there's still a number of decisions that need to be made around them. And if you drill down in some of the index funds, they can actually track different things, even though they're tracking the same thing, if that makes sense. So, as we know, whether it's the ASX 200 or the ASX All Ordinaries, or whether it's the accumulation index, et cetera, there are also rules around what's included in the fund. So, for example, we see from time to time that when a stock goes in or out of, say, ASX 200, it can mean a material difference to their share price. But there was an example they used with Tesla going into the S&P 500 in the US, where there were some other rules being applied by the ETF providers around how much free float there was, whether, I think from memory, there was a rule around how many quarters of positive results there had to be before they would include a stock in the S&P 500 index. So not just the rules the S&P had for putting a stock into the 500, but there were also rules that some of the ETFs had about including it. So this particular example showed that on some metrics, Tesla qualified for inclusion in the S&P 500 index when the share price was something like $60. And for some ETF providers, they didn't include it until it got to $200 because they had some other filters that they applied before, qualifiers that they applied before they included it in their ETF. So that was another active decision around whether you just by rote follow what S&P say or whether you provide some other metrics on inclusion and exclusion. And then there was also some research to say that, as we've seen, when the quarterly rebalancing is done, there's a lot of trading going on. And depending on whether you narrowly do your trading at the time of the quarterly rebalance or whether you do it over time, that can have an impact on the ETF performance versus the underlying index as well. Because if everyone's trying to buy a share going into the ASX 200, it's going to push the price up, and that might settle down again. Whereas if you do it as kind of a smoothed effect over, say, a month or 2 months, it will have a different cost base for you. And so there's active decisions being made around inclusions and exclusions. And lastly, the other thing which was interesting was that you might be buying an ETF for the ASX 200, but because of liquidity, some of the stocks at the bottom of the 200 are often what they called sampled. So they won't necessarily buy the market weighting across the tail of an index. They might just do some sampling and buy some shares in some stocks and just say, well, we think, we can sample, say, the last 50 stocks. I'm just picking a number here in the ASX 200 without having to track each of those shareholdings against the index as they trade each day, which can be volatile. So I thought that was interesting as well. So they can easily trade in BHP, CommBank, the big stocks. They can't easily trade in the smaller stocks without pushing the price around. And the smaller end is also more volatile. So they sample the smaller end. So that can also have an effect on why different ETFs look a little different in their performance versus the underlying index. So interesting to drill down into that, I thought. So that was my news for the week. And the last thing I've got to do is a pulled pork on Beach Energy. I keep going to call it Beach Petroleum, which it was once known as Beach Energy, BPT.
It's funny because I added them as a recommendation for light members yesterday, I think, and I was like, I went looking to see if you'd done a pulled pork on them in my pulled pork list. I was sure that you had.
Yeah, I thought I had
I couldn't
too.
find one.
I did the
Must
same
have been
thing.
a long time ago.
Yeah, I did the same thing, and it may have been way back when we first started. Because I know it's been on and off the buy list for a while, but the share price has really traded sideways in a band over the last 5 years. So it's pretty much about where it started 5 years ago in terms of its value. So I may not have done a pulled pork over that time, but certainly we've talked about goes into our reviews. Yeah. And I should also say, before I go into this, it's 1 cent above its buy price today as I'm doing this. So, it's possible that when this goes out and people listen to it, it could have fallen below its buy price again. So certainly check into it yourself before making any decisions. And I guess lastly, of course, this question always arises when I do a pulled pork on a fossil fuels company. One of the benefits of QAV is you don't have to buy everything on the buy list. You can put your own filters over it for ESG reasons. If you don't want to buy a fossil fuel stock, don't take this as a recommendation. It's simply an analysis of a company for people who are interested in buying companies, regardless of whether they're mining or drilling for fossil fuels or not. What is Beach Energy? Well, it's an oil and gas explorer. It has 5 broad operations across Australia and New Zealand. It was founded in 1961, started as a small and pioneering oil explorer in South Australia's Cooper Basin, which is up near the border of South Australia and Queensland. And since that sort of one-off find has grown into a significant player in the energy sector in Australia. They also expanded through acquisitions and partnerships and are headquartered in Adelaide, South Australia. They're a key supplier to Australia's East Coast gas market. They operate in the Otway Basin, the Lang Lang, have a gas plant in Lang Lang in Victoria, and they also supply gas from the Western Australian Perth Basin. It's called the Perth Basin, but I think it's a fair way north of Perth, but it's called the Perth Basin. And they have a JV arrangement in Taranaki, New Zealand, in the Cooper Gas project over there. What else can I say about them? I think I've got some history on them here. it was established, formerly called Beach Petroleum, was established in the early 1960s by the late Dr. Reg Sprigg, who was a highly regarded Australian geologist, explorer, and conservationist, according to the bio. The first well was called Grange 1, and it was drilled at the site of what today is the Grange Golf Course near the Adelaide Metropolitan Beaches, which is why the company is called Beach Energy. And the Grange Golf Course, for anyone who's a fan of golf like I am, is where they play the Live Golf event in Australia. There's some talk of moving it, but that's where they played it last year, or this year, sorry. The company then pioneered exploration in the Otway Basin, which is the sort of tip of Victoria, south-west of Melbourne, and also started the found commercial gas discoveries at Port Campbell in 1979. And in the 1980s, they made oil discoveries at Jackson, Badella South, and Kenmore in southwestern Queensland. And I couldn't see whether Kenmore must be a separate place to the suburb of Brisbane, I'm guessing, but I couldn't see where it was on the map. I'm assuming it's in the outback Queensland area. In the 2000s, Beach relocated its headquarters back to South Australia and expanded its operation with a focus on the Cooper/Eromanga Basin. In 2016, Beach completed the merger with Drill Search, expanding its Cooper Basin footprint, and then in 2018, Beach acquired Lattice Energy, resulting in substantial growth of assets across Australia and New Zealand. That's all according to the Beach website. Quarterly results. So I should point out we're about a week away from them releasing their quarter 4 numbers. So being an energy stock, they release quarterly numbers. They're going to be released on Thursday, the 31st of July. And effectively, because they release quarterly numbers, it's a pretty good indicator for what the final result will be as well. And so this company typically doesn't take long into August to give us year-end numbers, and I think they're down. Or last year they reported on the 12th of August, so we should see numbers from Beach, an indicator next week, and then the final numbers a couple of weeks after that. So bear that in mind. People might want to wait for another week before they make a decision to buy or not into this company. Their quarterly numbers were okay, but not great. I'll just dig them out. So for quarter 3 so far anyway, which is the quarter ending March 2025, they showed a 2% reduction in sales quarter on quarter, even though the oil price was up 8%. However, net debt was reduced to 8%. Kind of a flat result on sales, but they put whatever they earned to good use and reduced debt. But there are a couple of things to note in quarterly numbers. They are affected by delivery timings, particularly of large LNG cargoes. So sometimes they can the numbers can be a little bit down because there's less shipments going overseas this quarter versus the last quarter. And they also reported after the quarter that there was some flooding in parts of the Cooper Basin, which affected their drilling for new reserves up there. So that could affect the quarter 4 numbers. And they also highlighted that their capex was going to be at the low end of what they forecast, revised down due to that flooding in the Cooper Basin, but also the availability of oil rigs for exploration in the Otway Basin off the coast there. So a couple of things which may affect the Q4 numbers. On the plus side, in the quarterly results in Q3, they have a plant in the Perth Basin called Waitsia, and Waitsia Stage 2 is close to final commissioning, and the first sales were forecast around about now, so we might see an update on that in the quarterly numbers coming up. Just 2 other things to note before I go into the QAV numbers. There's a large amount of stock. It's about 30% owned by the Seven West Group in Beach, and Seven West is the investment company for the Stokes family. And Kerry Stokes is the father, and Ryan Stokes is the son, and Ryan sits on the board. and the holding is in Seven West Group, which the Stokes family controls 57% of. So fair amount of ownership in Beach, and a board position for the Stokes family. They they may use the creep provision to increase ownership going forward, which allows them to add 3% every half to their holding without having to worry about going over the 19.9% ownership cap. Under corporations law, if you own 19.9%, you're meant to lob a bid for the company and buy out everyone. But if you use the creep provision, you can get to a higher shareholding without doing that, which appears to be the case. Pluses and minuses with this sort of involvement by the Stokes family. It worked out well for Boral shareholders in a similar situation when the Stokes family finally did decide to take the company private. They lobbed the bid at a premium to buy out the other shareholdings. But I do remember going back many years when I owned shares in a company called West Australian Newspapers, when the Stokes family crept up that and then took it out and merged it with some of their other holdings, I think Seven West Media, at a price for lower than what I paid for it to buy in. So it can work both ways. But certainly Boral, if they follow the Boral playbook, if they are interested in taking it private, they've been sitting on the register for a while now and haven't done anything but try to improve performance, which is also their playbook. And Ryan Stokes has been good at doing that for the boards he sat on. That should be a positive for shareholders. And one of the changes he made was to replace the MD. And so last year, I'm going to read from an article dated June 18, 2024 from the Fin Review about the new MD. Beach Energy's new boss, Brett Woods, intends to diversify the oil and gas producer into gas power generation and storage as part of a far-reaching turnaround strategy designed to leave 5 years of underperformance behind. Mr. Woods, who joined Beach in January from Santos, also expects to emulate the success he was part of driving at the larger rival in reducing costs and improving returns, setting strict new targets for costs and cash flows. My goal is to set up Beach to be a high-performance, low-cost organisation that takes advantage of its strong position on the east and west coast and is well positioned to take advantage of its really good balance sheet to enable growth, Mr. Woods said. Certainly, I have learnt a lot from Santos CEO Kevin Gallagher on the way we can go about it, and my intention would be to emulate the success we had at Santos between 2015 and 2020. And I guess the markets hasn't rated that strategy well because the share price is lower now than it was in 2024. But he's making all the right noises anyway going forward, and we'll see what happens with his strategy to reduce costs and be more disciplined, which is not a bad thing. So hopefully he's successful. On to the QAV numbers. Stock price for the analysis is $1.37.5, and that's above consensus target by 2%, above IV1 of 28 cents, but below IV2 of $2.04. It's also below net equity per share of $1.53, so we can buy this for less than book, and obviously less than book plus 30. Yield is 3.64%, so less than our cutoff for a score. Stock Doctor Financial Health and Trend is strong and recovering, so it gets a score of 2 for recovering trend, which I like. Stockopedia rank it highly for quality, 95 out of 100, and overall 98 out of 100. So Stockopedia like what they see in this company. And the F score is 8 out of 9, which is excellent. For what it's worth, if anyone's interested, ROE is quite low at 3.5%. So we don't score it based on that, but not a good side to have a low ROE, I would have thought. This is one of the companies where the PE is 25 times, so it's the highest in 3 years, so we give it a negative score. However, prop cap is only 2.9 times, so throwing off lots of cash, but obviously being used for running the business, and I would think a lot's going into capex and drilling for expansions of the current reserves. So the cash is being put back to work, but good prop cap and high PE for this company. EPS growth is forecast in Stock Doctor at a very high 271%. So growth over PE scores for us when it's 10.79 times, which seems very high, but I am wary of that given the quarterly results, and Stockopedia says the forecast earnings per share will be down 1.5%. So I can't marry up those two things, but if Stock Doctor's out with its forecast, it's not going to make a material difference to the QAV score. But just bear that in mind. There's some discrepancy on what the forecast earnings per share is being reported in both those two sources. Stock Doctor lists directors only holding 1% of the stock. However, we know that the Stokes family holds 15 to 30%. 30% in Seven Group, and then they own slightly over half of that. So you could argue it's 15%. Not strictly an owner-founder, and so I haven't scored them a 2 for that, but there is a large active owner on the board, which I think is probably a good thing. Stock is a recent 3-point trend line buy. We score it for that. Equity is not consistently increasing, so we can't score it for that. So all in all, quality score is 12 out of 17 or 71%, and the QAV score is 0.24, which is reasonably high. A couple of the risks and some of the positives. Obviously, we have to follow the commodity trend lines for this, and at the moment, gas, which is probably the one to track for this company, is a buy. Oil is a Josephine, so bear that in mind as well. There are lots of regulatory and environmental risks for a company like this. There could be stricter climate policies and government regulations coming down the track. There's a lot of work, I think, to be done on East Coast reservations, so how much gas should be sold internally versus offshore, so there could be some changes to regulations there. There's obviously both risk and upside in the fact that there is lots of drilling going on in the Cooper Basin and the Otway Basin and in the Perth Basin, any of which could, if they strike a big reserve like we saw with Perseus, could improve the assets for the company and re-rate the share price, but also too it could be in vain, which is costly and may not re-rate the share price. So that could be both a risk and a positive. And then there's the general trend towards renewable energies, which could eventually impact on fossil fuel companies. As you know, my take on that is, number one, we're buying shares from other shareholders and not putting money directly into Beach if we buy these shares. And number two, I think we need to keep the lights on while we do transition to more dependence on renewable energy. So if there is a risk, this sort of company is going to be around for a couple of years yet while we transition. On the positive side, though, if the MD does or is successful in a more focused and disciplined strategy in exploration, then that's a good thing. And of course, the exploration results could provide upside for the company, which will eventually re-rate the stock as well. So that's Beach. Do your own research, decide whether you want to invest in it or not. But at the moment, it's turning around according to our trend analysis.
Thanks, TK. Just checking the commodity status for LNG and crude again. I've actually got LNG as a Josephine today too now.
Okay. I'm just going on the buy list that you had over the weekend.
Yeah. I think they're both Josephines as of today, just FYI, folks. It was a buy when I last looked at it, but it's turned around since then. Very good. Beach Energy. Yeah, I was trying to figure out when the last time I held them was. It's been a while. BPT. Back in 2023, sold them in, earlier this year, sold a parcel. 3-point trend line sell. Yeah, I've sold them twice as a Rule 1 and once as a 3-point trend line over the last couple of years since 2023. Sold them somewhere between 125 and 145. What did you say they're at today?
From memory, it was about $1.37, I think. The price $1.37.5. Yeah.
So they haven't really
no
moved much in that period of time.
Correct.
All right. Well, that is QAV. We're into after hours. TK, what do you got? What do you got for me?
Well, I've been watching the British Open, so that's been my sort of entertainment diet for the weekend, or the Open Championship as they prefer to call it. They get quite prickly when people call it the British Open, but everyone calls it the British Open. So,
why do they get prickly about that?
Because it's officially called the Open Championship. And when I've pushed people over there as to why they get upset about it, apparently, and I don't know if this is the case, but apparently Northern Ireland is part of the UK, but not Great Britain. So they call it the British Open. If we call it the British Open, we're not including Northern Ireland, which is where it was played this year. But that's, splitting hairs. You can, and when the English split hairs on things like that, you can see why the English language is so hard to learn if you weren't born speaking it.
I also see why everyone hates the Poms. Like, just get over yourselves. You
Exactly.
get Great Britain, England, the United Kingdom.
Yeah.
Come on.
Just call it the British Open like everyone else does. But that was good fun. Good fun to watch. There was at Port Russia, Northern Ireland, which is where I went to with Ruddy when it was last there in 2019, prior to COVID. Had a great time in Northern Ireland and the rest of Ireland on that trip. They had I think this year they had much better weather. When we were there, it was just cyclonic, the wind and the rain. And was won by a local Irish player. This year it was warm and sunny and the Americans prevailed. So that was interesting. But the other thing we did this week was after watching The Offer, Jenny wanted to go back and watch The Godfather, so we did that, which was great. She hadn't seen it since it came out, and I hadn't seen it for a couple of years. Yeah.
She hadn't seen it since 1972?
Uh-huh.
Wow.
Yeah.
Chrissy and I kind of watch it at least once a year.
Oh, well, we don't do that. But it was great to watch The Offer and then go back and watch The Godfather and just get blown away by it again, and knowing some of the backstory on how it was created, and really came away with the feeling of it being just like every scene is so special and just delivers a punchline in every scene. Set up, usually with a background of something big happening, a wedding, a funeral, whatever, and then tie it into a couple of protagonists and then punchline every scene, which was really, really quality filmmaking.
Yeah, and like it just holds up so well.
Oh,
It's
yeah.
so beautifully shot. The
Mhm.
performances are so great. The story's so great. And the second one, arguably even better. The part 2 with
Well, that's
going backwards and forwards.
That's our next watching this week. Hopefully, we get to that.
Yeah. Well, thank God for Bob Evans, who saved it on the cutting room floor, as we joked about last week. Yeah, no, just every time, like I never get tired of watching The Godfather. It's just such a masterpiece. My only complaint over the years has always been James Caan,
Not Italian.
as Santino. Not Italian. Doesn't look at all Italian.
No. And was the pick to play Sonny, and that was the compromise.
Yeah.
They said we'll keep him in, but we'll give it to Al Pacino, but we'll keep James Caan in.
Yeah.
Mm.
Like he just does not fit with the rest of the cast at all. But
impressive.
Yeah.
He's impressive. I mean, physically very impressive. Plays the part really well. It's a great part, but it doesn't look like he's part of the family.
He can do anger very well, and goes off his rocker and all that kind of stuff. It's great. Don't want my brother coming out of the stalls with his dick in his hand. Great line. Anyway, very good. Godfather. Well, I haven't really watched anything to speak of. Was watching a bit of John Wick 2 last night. Still just appreciating John Wick. Was doing knife defense at Kung Fu this morning with my Sifu. And he was like, you get stabbed and that's it. It's all over. And I was like, I saw John Wick get stabbed and he went on and fought 500 guys. I saw him get shot in the abdomen and then ran at full speed for hours and hours through catacombs and took out a bunch of guys. Was doing kung fu on people after getting shot in the belly. Uh, Either being shot or stabbed in the belly isn't as bad as you're making it out, or I shouldn't believe everything I see in a John Wick film. Either way.
That's like
Anyway.
a comment we made about The Godfather with the Corleone guys can take all the bullets. Like you see Don Corleone being shot, and he gets shot about 5 or 6 times, and he falls on the car and rolls over and lives. And then you see Sonny being shot at the toll booth, and he's like machine gun, but he still gets out of the car and stands up, and he gets machine gunned again. And takes about 30 bullets to kill him.
Yeah, all the squibs going off. That's crazy. But then, I've been reading this book on Robert Maxwell, and it's fascinating. Like, I had no idea. I mean, I kind of, I remember hearing about Robert Maxwell in the news in the 80s and when he died and that kind of stuff. Never really paid that much attention to him. Knew he had a great rivalry with Rupert. See, Trump has sued Rupert for $10 billion or $20 billion or something now. So he's suing Rupert, who owns the Wall Street Journal, but also owns Fox News, which is sort of his number one fan base. And then there was a story that J.D. Vance went and spent a couple of hours with Rupert and Lachlan a month or so ago. And then that's followed by the Wall Street Journal article about Trump's birthday picture drawing for Epstein and the suit. Like, what's going on? How does Trump think this is going to play out if he's suing the guy that owns Fox News?
Yeah, exactly.
It's hard to figure out how much is performative theater, how much is real.
Oh, I think Trump's lashing out to try and stop the Epstein files from coming out. But I don't know what's in it for Rupert to prosecute it.
Well, the word on the street has always been that Rupert completely loathes Donald Trump. Like, as everyone pretty much does, including his own administration, I think. But, I don't know, man. It's fascinating. But anyway, the Robert Maxwell thing. Maxwell's story is fascinating.
Just before that, did you see Stephen Colbert's been cancelled?
Yeah. And the theories behind that?
Yeah.
I read Nate Silver did a big post on it today. Did you see that?
No, I don't follow Nate Silver.
He did a big analysis on it and talked about all the different theories. And, there's no doubt that late night shows and the big television networks are doing it tough. The economics of all of that is hard to justify these days with the fragmentation of attention towards TikTok and streaming and all that kind of stuff. Whether or not it was just a political hot potato after Colbert called Paramount's payoff to Trump to get out of the court case over 60 Minutes a big fat bribe, and they just decided, you know what, we don't need you anymore, we'll get rid of you, because Larry Ellison's son wants to take over Paramount, needs Trump's approval, etc., etc. I don't know. Interesting how all these big media companies and big law firms are paying off Trump.
It's so-called,
Colbert said, it just looks a bribe.
So-called independent organizations,
Anyway, back to Robert Maxwell. He was born in this little town in the middle of nowhere in Czechoslovakia, sort of on the border of Czechoslovakia and all the other countries around there. Born to a poor family of 9 kids. When he was 16, he left home and went and joined...
Was that called the Maxwell House?
Well, funny you should mention that. So his name is not Robert Maxwell. No, his name is like Jan Koch or something. Changed his name 3 or 4 times during World War II, settled on Robert Maxwell. And then later on, when he started building his empire in the United Kingdom, in London, he did buy a building and called it Maxwell House.
Was Was there a big
But
coffee, like a big spoon coming out of the roof?
I think he got sued, or they had some trademark issue with the coffee brand in the United States. But anyway, born with this poor family, 9 kids. He goes off, joins World War II, goes off, and later finds out that his entire family got killed by the Nazis. His mother, all of his siblings, except 2 sisters, survived. They got gassed at Auschwitz. His father got shot by the Nazis. So he's a Jew, right? They all got exterminated. But he ends up sort of becoming part of military intelligence in World War II, working for the British, and changes his name and adopts a British accent and takes on the persona of he's a bit like Don Draper in Mad Men. He just takes on this persona of this British upper class gentleman, ends up getting funded by MI6 to buy the rights to a scientific publishing business out of Germany that was trying to figure out what to do with all of its scientific literature that it hadn't been able to export or sell globally during the war. So he buys all of these books, but it's funded by MI6. So the big question at the moment with the Epstein stuff, which you probably have seen, is whether or not Epstein was working for Mossad and the CIA, and how the line from him goes through Ghislaine Maxwell to her father, who it seems was a Mossad agent or was Mossad adjunct or something. I'm still trying to get to the part of the book where they talk about that, but he did seem to be, his early entrepreneurial activities were funded by MI6. And when he died under mysterious circumstances, falling off his yacht just after he'd taken over a big New York tabloid. That's a great story. So he took over this tabloid in New York in 1991 that was about to go out of business. He took it over and then made the managing editor of the newspaper Paul Rupert Murdoch. And just to tell him, Robert Maxwell has just bought this paper. That was the phone call. So he calls Rupert. Rupert was in Australia at the time, apparently. Calls Rupert in the middle of the night. Rupert answers the phone. He goes, yes. He goes, it's John Hodge from the Daily World or whatever it was. Robert Maxwell wants me to tell you that he just bought this paper in New York. Because, of course, Rupert owned the New York Post at the time. Mm-hmm. He said Rupert just burst out laughing and said, tell him that's fantastic. Just the rivalry between the two was great. Anyway, so when he died, there was this massive state funeral for him in Israel, attended by prime ministers and the former heads of all of the intelligence services and all this kind of stuff. So he was beloved by Israel for some reason. Anyway, but so his whole family died. Then he had 9 kids of his own, and 2 of them died very young. One from, encephalitis, and one from a car accident. His eldest son got brain damaged in a car accident, survived for like another 10 or 12 years, but was a vegetable. And it's a lot of tragedy in his life, but managed to somehow turn himself into this media baron. And by the sounds of it, kind of one of those sort of psychopathic dudes who just treated everybody around him like shit and, yelled and screamed and abused his way. Could be extremely charming and flattering, but also extremely volatile and abusive. And when he took over the newspaper in New York in 1991, they were talking about how the security staff welcomed him to the building, and the first thing he did was fire all of the security staff because he wanted to replace them with his own security staff. So he just walked in and got rid of everybody, got rid of all of the staff in the paper, and et cetera, firing the people left, right, and center on day one. Anyway, we'll see how that goes. That's about it, Tony. That's all I got for you. Been listening to a lot of the go-betweens too. A lot of the go-betweens this week. Watched a good documentary on YouTube on the go-betweens on the 16 Lovers Lane album, which was fun.
Oh, look. I watched that Tarantino clip on Dirty Harry too. It was great fun.
It's great, wasn't it?
Yeah.
Yeah,
very good.
Okay.
All right.
Have a good week, Tony.
Yes. Happy ASX, and let's hope it makes another market record this week.
Yeah. No, I want it to crash.
Oh.
I want the market to crash so we can have a boom post-crash year. Fingers crossed for a crash.
Well, I'm not going to hope for a crash. I'm happy to keep taking outperformance in good years.
Okay.
All right.